Good to have you with us. Thanks for joining, Andy. Ben, how are you?
I'm doing okay. Good to see you, Dana.
Yeah, good to see you. Are you making progress?
Getting there. I'm about at the point where I'm going to start reaching out to brokers this week. So
Good.
I got my pre-qual letter, my buyer profile. Still talking to banks.
Good. Maybe there would be a nugget in today's conversation that can help, hopefully. Got about 3:02. Let me get the presentation up with us here. Get ready and get started real quick. Everybody see that?
Yes.
Yep.
Yes, can see it.
All right, good. Let me go ahead and get started. This is I apologize in advance. Dealing with a banker is a pretty dry topic to begin with. I'll try to add a little bit of color to it, enough to keep you from falling asleep if I can. But that can be a challenge at times. And thanks to Dick Hendy. Dick is the one that actually developed this this presentation. He is a former banker as well as myself, and we talked about this last week. He knew he wasn't going to be able to be here, so I told him I would deliver it and take any questions, and probably able to handle those kinds of things. If you have any questions that I cannot answer, I will definitely get back to you with an answer. So let's get on it. Banks are all different, and they are, when we think about a bank, we think about money and the color of money, but they're not all the same. And frankly, you don't really deal with a bank other than to make sure that the bank has the capability you want. If you want treasury, don't deal with a bank that has a lousy treasury management system. If all you want is money, then there are ways to take a look at what you need and match it to the bank. But the bottom line to dealing with banks is you're dealing with an individual. And what you want to make sure is that the individual probably today is not a decision maker. Most of the time, they will collect information from you and others will make the decisions for them. What you're really looking for is who has influence within that bank and can influence the decision makers. So you're looking for somebody that is trusted by the bank's credit decision makers. That's the real key. One of those types that we have is a guy by the name of Alan Peterson. A lot of you know him. Probably several are already talking to him. There are others as well. And y'all are free at any time to go to any bank you want if you want to look for a financing source for your acquisition, or to finance your bank or your company after the acquisition. But long and the short of it is you're looking for the individual that you mesh well with and that you communicate well with and that you have confidence in. And that's not always the case. So just make sure you've your antenna are up when you're interviewing bankers. So if you know that banks are averse to lending, they're averse to taking risk is what they're really averse to. And some are better at mitigating risk than others. Usually it relates to the individuals involved. And without getting too wonky on you, let me just, in case you hadn't seen like this, it'll be intuitively obvious to you, but let's say a bank makes this is why banks are so risk averse and they act so strange at times. Let's say you borrow $1 million from them. Today, let's just say today the spread, the spread between their cost of funds and what they charge you, let's say that's about 6%. Okay, their cost of funds is 4%. That's what they borrow it for, and they lend it out at 10. So they're making a 6% gross margin. So they lend you $1 million, they make $60,000 gross margin on it. What makes them so risk averse is that if they lose that $1 million loan, they made a poor judgment, something happened, the company went bankrupt, they didn't collect a thing, they've lost $1 million. And what that means is at that margin, they've got to go back and make 17 loans just like that, just to make up the loss they had. So that's what drives their thinking. And when you've been in a bank as a manager or, responsible for a profit center within a bank, making loans like that, you get pretty risk averse. And that's why they get really kind of strange. And sometimes their decisions don't always make sense to you. But it will really pay off for you to realize that and use that as you conduct your relationship with them. You want to give them more than what they ask for. You want to anticipate what they're going to need. All of those kinds of things means that you're trying real hard to be a good customer for them. Not everybody does that. And I can tell you that the experienced ones like dealing with experienced business people that know what they need, why they need it, when they need it, and are willing to give it to them and not make them pry it out of you. So if you govern your relationship with your banker with that in mind, you're going to be way far ahead, as opposed to, if you treat them as a second-class citizen and I'll only give them what they need if they nag me enough for it. So hopefully that kind of makes sense, and it explains why they're so risk averse and they get kind of weird about loaning money. They're loaning, they're not investing. Their margins are way slimmer than say the investor that invests with you for a planned 30% year over year return over the next 5 years, figuring that you're going to make something of that company. That is a much different margin, much different decision, and they don't have to hit on and be correct so many times as a banker does in order to make money. Any questions on that? Any observations or questions or anything like that? Okay. So this is kind of a little continuation, same line of thought. They don't want to be your partner. They want to be your lender, and they want to pay the loan back. And they don't want to lose money on it. So I asked a banker at one point, the CEO of a pretty big bank down in Houston, how much money you had to lose your job. And his instant response was $400,000. That was it. It was instant too. There was about 2 seconds between my question and his answer. I was a little green at the time, and probably wasn't a true answer because there were people that lost a whole lot more money than that. The other thing is they don't want to tell you how to run your business. They will if they have to, but if they start telling you how to run your business, they're very careful about how they do that, and it's not going to be the person you first started dealing with. I can assure you of that. So just more about risk-averse bankers. When they look at lending you money, this is historically what they used to do. It's done a little differently now, but they basically, sort of the bankers' theory was the 4 C's: character, capacity, collateral, and capital. And you had to pass, the check. You had to check off each of those boxes. If you can all see that, then it's pretty much self-explanatory. I won't read it to you. The bottom line is, if you pass all those, all those check marks are checked on your slate with that banker, the chances of you losing money and them losing money are pretty slim. But the thing is, today, not all bankers bank like this anymore. There's been a move over the last 20, 25 years to bank by the numbers, especially in the lower end of the banking business, which is where we are. We're, loaning anywhere between, $1 and $6 or $8 million. There's a lot of computerized analysis of credit records and all sorts of things that will gin out a decision. Somebody will look at it. Somebody in a credit decision-making role will look at it and see, does this make sense? Look at it, and that will generally, if the structure is right, that will generally create the decision for them. But with folks like Alan, for instance, and others, they're still looking at capacity. They're looking at collateral, although with the kind of loans that you guys are making or asking for, the collateral with the company you're going to buy is not going to pay their loan back. It's a way to get some money paid back if the worst happens, but it's not like loaning 80% of the value of a gold bar. It's not that kind of a loan. So what they're lending against is cash flow, and hopefully you'll have enough skin in the game that they can feel comfortable that if things go sideways, you will fight to protect yourself, and in doing so, you'll protect them. And that's kind of the theory behind them, and that's why they'll take a risk on a cash flow loan to a plumbing shop or some other kind of business that, the equipment, you may borrow $2 million to buy a plumbing shop, and the equipment and the assets are only worth about $600,000 maybe. But that's why they'll take that risk. They can predict the cash flows and apply that to the loan, and over time it will be repaid. So these character, capacity, collateral, and capital. Those are all the traditional ways that bankers evaluated loans. Today it's a little different, but there's a mix of both. So any questions there? Good. I think everybody's overworked and underpaid. Bankers certainly feel that way. My observation, and keep in mind that I am very opinionated about this, but over the last 25, 30 years, there's been a transition, and maybe a little longer than that, kind of a transition between bankers being advisors and doing their own analysis and understanding what they are doing, to a position where the people that you're in contact with are really collecting information and bringing it to others that you may never meet, may never even hear their names. Those are going to be decisioning credits, and they are typically not getting out of the bank too much. So for the most part, the ones that you're meeting that are out on the street, I can't speak for the ones that are in these internet type banks, but the ones that are local, that are out on the street calling on people, are just gathering information and bringing it back to the bank for other decision makers to look at. they may get a message from a decision maker that says, we need 2 more tax returns, or we need X, Y, or Z to be able to make this credit decision, and they'll go out and get it. The individual that you've met will go out and get it. I suspect that that's pretty similar with some of the internet banking approaches that are taken. It helps a lot. It will help you a lot. It will distinguish you at that bank if, when you apply for a loan, you actually give them a fully developed plan and everything that is required to document what you're doing and what you intend, whether it's receivables agings, inventory listings, equipment listings, all of that stuff. Maybe evaluations on some of the assets. To the extent that you have it, I would provide it, and definitely give, if it's Alan or if it's somebody else asking you for a comprehensive list of information, make sure you get that from your target company and get that to the lender, and make sure you've looked it over so you understand what it is. Because you may get some questions about it as well, and you want to be prepared for that. So last week, Dick covered business plans. I think you probably all got his presentation. That should be helpful to you. If you don't have it, go take a look at the library of information. And Andy, I'm not sure exactly, is this stored, those presentations were sent out, or are they just available in a location? Andy?
Sorry, what was that again?
Are the business plan, is the business plan presentation that Dick made last week, is that available to people, or was it sent out to the AEs?
I sent it out to all the AEs who attended last week.
Okay, perfect. Thank you. I appreciate it. The one thing that Dick mentions in this last bullet point is, you can present this to 5 different banks and get 5 different answers. I would pick at a minimum 3 and present them and see how they respond, see how flexible they are. One of the degrees of flexibility we have incurred for some time, is to make sure you've done enough working capital planning to make sure you've got a working capital reserve in the event that you've got a downturn in sales, or receivables that you took over are slower than what you anticipated, which could easily be the case. You want to make sure you've fully planned for any eventuality there. So Bank A might not plan for that at all. Bank B might plan very well for that, and Bank C might have some other approach. And what you want to do is make sure you understand the way they're approaching things, and in terms of structure, in terms of the bank structure of your credit facility or facilities. And you want to make sure that fits what you're comfortable with and the kind of business that you're acquiring, and that you have some dry powder if things go sideways a little bit once you've bought the company. It's not unusual that things change in a company, and ownership changes, and there are some unexpected things that you need to deal with. They're typically not killers, but they can be serious, and you need to have planned and been ready for it, as opposed to trying to deal with it spur of the moment and not having a plan at all. All right. When you make a request, I would put my request down on, basically develop out a term sheet and put that in your plan or in your request, and give that to the banker as the initial discussion point, and talk through it with the banker. And then what you can do is have a meaningful discussion. And the banker may say, no, you didn't think this one through. We can do this and it'll be better. That's typically what you want to hear. But you want to go to them knowing the kind of structure that you think will work, and ask their advice. Will this work? Why will this work? Why are you suggesting something different? Why is what I've suggested not applicable for whatever reason? And it's really incumbent upon them. They want you to understand what they're doing and why. Let's see. Oh, Dick's last point on this slide is a good one. You are not going to find a deal where it's perfect. Everything is great. There are no weaknesses. It's just, I've never seen one. Doesn't happen. So what you want to do is make sure you've identified them, talk about mitigating factors and how you're going to manage them. And that is the best you can do. If there are too many of them, you may want to rethink whether you want to make an offer on the company. But and that's a matter of judgment. But there might be 6 or 8 small things that you can manage all of them, or there might be 2 or 3 really serious ones that might cause you to question whether to go forward. So all of that is judgment. We can help you with making those judgment calls at times, but most of you will be able to. Your antenna will be up if you see something that really makes you uncomfortable. And don't be afraid to ask questions. Ask questions on these AP calls, on things like that. Ask questions on Slack. Don't be afraid to ask questions. In fact, if you don't ask questions, you're making a mistake. So, and I know enough of you now to know that you're pretty good at asking questions, which is a good trait. So, any questions at all? Anything so far that I've covered? No?
I have a question, Dana.
Okay.
This is bad. And apologies if this is covered in the training. I'm probably about halfway through. I'm up to the last mile. But like, what does engagement with the bankers look like throughout the search process? So like, right now I'm talking to 5 or 6 banks trying to get my pre-qual letter. Let's say I find a deal I'm interested in. When do I send it to them? Is it before the LOI? Is that after? When after the LOI do I engage with them? When do I narrow down from 5 banks? When do I have to pick a bank? Like, what does that look like?
Yeah, sure. The way I would do it, I don't have a stock answer for you, Ben, but the way I would do it is I probably wouldn't bother them before I have an LOI unless it's something I'm pretty sure I'm going to make an offer on. But with most of you, when you reach that stage, your LOI is out the door pretty quick. So what I would say is you send an LOI out the door, you get a counter signature, you may negotiate a few points, and you come back and here's what you've agreed to. I would probably, at the same time that I'm asking for due diligence items to be sent to you, send me this package, and I'd like it to include X, Y, and Z. I think I would alert the banker. I would say, look, George, Ellen, Susan, whatever. I think I've got a transaction here. I have a countersigned LOI. I'm going into due diligence, and just giving you a little heads up. Right now it looks like I might need to borrow $3.5 million. I'll put $300,000 into it. I'm going to ask for a seller note of X, and there's a lot of inventory. There's some receivables, and it's this kind of business. And is there anything else I can get you to kind of have you ready when I get enough material for you? It doesn't hurt to communicate with them. You'll probably hear back from them. Let me know when you've got your diligence package or something along those lines would be my guess. But you're developing a relationship. I would let them know. When I was in banking, I thought it was great when people had there's a difference between borrowers. Some would say, I've got this thing coming up and I think it's going to hit around May 15th. And there'll be quite a bit to do at that point. And I'm working on developing all the materials. Here's the round numbers. Here's kind of what it looks like. Okay, you kind of got that in the back of your head. And when all of a sudden a pile shows up on your desk, you already know what the story is, or what most of the story is. You make a call to Ben and you say, okay, take me through this real quick. What's different, and you explain it. I can ask any questions. You can ask me any questions. You can say, hey, I told you 3.5. It's actually going to be more like 3.3. And those kinds of things. I put in a sample capital structure for you, and tell me what you think of it. Can we talk next Tuesday or something like that? And in the meantime, I'm negotiating with the seller on a purchase agreement or something like that. Having those conversations keeps a flow of information going that is very productive. There are no surprises. They know that they're going to be working that into their workload, and it just doesn't drop on them from off a shelf and surprise them and hit them when they're heading out on vacation. You want to have conversations going, and that can be, with more than one lender. It will take you a little bit of time and investment of time to do that, but I think it's very important for you to communicate well with your banker. If you don't, then you're taking the risk that they won't be responsive in an appropriate amount of time, the amount of time that you need. That makes sense?
Yeah, that makes sense. So like, let's say I'm talking to 3 or 4 banks that I get pre-qual letters from.
Yeah.
Like, when do I have to choose one? Like, what stage of the game is that? Like,
I think you go through this discussion period, you get them the materials they need to make a credit decision, and you want them to give you a term sheet on how they would go forward. You look at the term sheet and, I like number 1, I don't like number 2, number 3 could be, if I could get them to move on this or that point, then number 3 might be the one. So you can, you can be working your purchase agreement, and be also, you're basically doing some parallel work there, to do due diligence, manage the banks to giving you a term sheet on how they would finance you. It will be loaded with contingencies. It will say, dear Mr. Webb, we are happy to inform you that subject to X, Y, and Z, due diligence, blah, 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 that we have approved the following credits subject to. And you can look at that. Does that do it for me? What does that do in terms of financing the purchase? Does it give me any extra working capital? Is the structure okay? I generally found that the interest rate on a loan at this stage is probably less important than the structure, a lot less important. And everybody focuses on interest rate, and it costs you some money. But if you have the right structure, you can get through almost anything. And so you want to be working those options, and you will know as you get down into starting to work a purchase agreement with the seller, you will know that what you're going to accept from the bank, which bank's proposal you're going to accept. You'll know who you can work with. I'm comfortable with this bank's representative, but I'm not comfortable with that one. I can never get hold of that one, or that one is just telling me what they'll do. They're not trying to accommodate my request. There's a difference. You know what I'm saying? So there is some flexibility that some of these folks have, and a lot of it depends on the institution and the individual. So I'd get a minimum of 3 and see what works for you, both in terms of the relationship, in terms of the structure, and later on in terms of the interest rate, which is ultimately the cost. The real cost is going to be involved with the structure, in my opinion.
That's super helpful, Dana. Thank you.
Does that help? Okay. I mean, I'm open to a call if somebody has a question about that later on, but you will know. Your gut will tell you, I like this, what this person, and don't just take an empty promise. I mean, make sure you are comfortable they can deliver. And sometimes you'll get younger, aggressive bankers that don't have the authority to do what they tell you they will do. That can happen, and you just need to. You all have the judgment to be able to make those kind of calls. Okay. And as I said, make sure you identify the negatives and just let them know how you're going to deal with them. Let's see. So you just closed. This is kind of a laundry list of all the things you need to do. It's not just making a payment. If the bank is on top of its game, it's going to know that you're keeping your insurance coverage current, you're paying your taxes if you bought some real estate or whatever. You're going to do that. You will be providing them tax returns each year, personally and for the company, and new financial statements, new personal financial statements annually. So just put that stuff on your calendar and get it to your banker. And if you're using a CPA firm, always best to get the CPA firm's financial as opposed to an internally generated thing, even off one of the software programs you can use. The worst thing, in my opinion, that you can give them is an Excel spreadsheet where somebody typed the numbers in. I mean, that's not really a good solution, in my opinion, if you're trying to build a relationship with a bank that's going to help you grow. Give them details. I would tell you to make sure you sign your personal financial statement. Bankers are told to look for that. Sometimes they overlook it, but I would just give it to them with a signature on it, and so they know that that's you saying to them, I stand by this. This is real. And you'd be surprised how many people won't do that. And that's always, a lot of times they'll accept it, and somebody will look at it in the bank 6 months later and they won't like it, and they'll come back to you and insist that you give them a signed financial statement. That's never a good sign. Business financials, I don't think there's anything really. Yeah, it's kind of this one right here. Don't overdraw your checking account. It's a pretty good policy. It doesn't. Bankers hate getting a call from somebody in their treasury section that says, "Hey, what happened to ABC Company? They just overdrew their account by $150,000 today. Why did that happen?" That's always a red flag, and it draws lots of attention, so you don't want that. No surprises. If you got something that's troubling you, tell them. Call them up, tell them, and tell them why it bothers you, what it is, why it bothers you, and what you're doing about it. and make sure you do whatever you can about it. Take their advice, ask their advice. So make sure you answer. If they call you, make sure you call them back. Pretty simple. Simple stuff. So I'm not so sure if you have a happy banker, you have a happy life, but you have a happier professional life if you have a happy banker. You definitely don't want one that's upset. And I've seen that a few times, and it's not really you really don't want to experience that. What questions or comments? Any observations or any thoughts or any other topics you want to bring up and chat about? We have.
I wanted to ask. Let me come off.
Yeah.
Hey there. I was curious, like, if you don't have a home as collateral, like, deal breaker, like how would you approach that?
So you don't have a home, as in your personal home?
Yes.
Well, I think a banker isn't going to look to you to have a home to buy a company. What they're looking at is they're looking at you in those 4 different ways, the 4 C's: character, capacity, collateral, and what was the last one? They're looking at you that way initially, and then they're looking at the capital structure in the company, the cash flow of the company. You know, if you have a home, for instance, here in Texas, it really doesn't make any difference at all if you have a home. Now, if you've got the cash to put the equity into the company that they need to make that loan, I don't think it's going to make a difference to them.
Okay.
If it does, I'd ask why. What's that about? Now, there are a lot of folks will go into a deal and they know kind of in the back of their head, I've got my home, it's worth, $1 million, and I've got $200,000 in loans against it. If I get in a tight with the company, I can borrow against my home to meet whatever liquidity needs I have to have in the company to keep it floating. I don't want to do that. That's kind of the last resort. But a bank can't make you do that. Does that make sense?
Yeah, that makes sense.
Okay.
Thank you.
I'd be astounded if they said, we're not going to make you your loan because you don't have a home. Just because you don't have a home doesn't mean you're homeless, and and if you're homeless,
yeah. I guess my question stemmed from, like, as I read through the course material, it didn't make it seem as a requirement, but it was alluded to, like, around, like, having collateral to put up against a loan, right? And so my mind just went to a house that you own.
Mohammed, the most of the deals that you see here, that I see with Acquira, most of the deals that I did in the last 10 years of my banking career were cash flow deals. And the reason that banks started doing things like this was they realized that when they had collateral, they couldn't get repaid. The collateral wasn't worth anything. It might have been worth $1 million when they made the loan, but if the business goes south or the industry goes south, it's not worth $1 million anymore. Okay. So it became really important for banks to understand cash flow, because cash flow is really what repay loans. You convert your inventory into a receivable, and that receivable into cash. That cash is what pays the loan. Then they're not going to bring back 100 pounds of whatever the inventory is to pay you. They're going to bring back cash. And so that's all the major transactions that you read about in the papers. Those are virtually all of them are cash flow loans. Okay. And it's the same at this level. It's just there are fewer zeros involved and there's higher risk involved because the businesses are so much smaller. That's why the SBA backs them.
Okay.
Does that make sense?
Yeah. Thank you.
Sure. And what else? Anything else? Any other?
Yes, I have a question for you, Dana. My name is Antonio, and thank you for the presentation.
Yeah.
So recently, I have been reading that SBA loans are getting or are having much more or a deeper analysis from the credit institutions. So I don't know if the banks are looking this kind of loans, such as the way the government, the Trump administration is looking at them, and if from your perspective is the good is it a good moment to get in and to have a loan for the next 3 to 5 years? I mean, we are looking to acquire a company and to repay the loan in that lapse. So 3 to 5 years is our goal. So I don't know if it's in your experience is a good moment to get in the risk.
Yeah, it's a good question. Antonio, I don't know the answer. I do know, probably not any more than you do. I read the papers. I sort of follow different news channels and all that sort of thing. And there's people are nervous today because of all the tariff stuff, that stuff's hitting the news, and Wall Street doesn't know what to do. And I can tell you this, that the extraordinarily wealthy folks are buying stocks that are depressed right now. They'd be insane not to, because you got to believe that the American economy, has a lot of power behind it. And while it has ups and downs, this is not, at least at this point, this is not a traditional recession-caused decline in the stock market, although it's traditionally viewed as a leading indicator. My sense, and I'm not an economist, I just, former banker and been around for a while, but my sense is don't let the winds around you change the direction of the ship. That would be my advice to all of you. And if you start running into that, and I appreciate the question, because I'll reach out to Alan Peterson and just ask him, because that's an important question. There are a lot of crazy things that have been found. Now, whether that impacts lending is another question. But one of the things you guys are doing is you're looking at companies that, the term that Acquira uses is recession proof, and there are greater and lesser degrees of that. But, I've been through a bunch of recessions in my career, and I've never seen plumbers that failed because of a recession. That hasn't happened. I don't think roofers are going to stop putting roofs on. I don't think electricians are going to stop doing the work they do. Now, there may be some interesting aspects to those businesses. If you're I've seen several businesses now for sale that are doing one of two things. They're either advertising that they are, 80% dependent on new construction. Well, that can be a pretty high risk situation. And I would at least make sure I understood that and what that actually looks like, because new construction in Nebraska may be way different than it is in Florida, or certain parts of Texas, or those sorts of places. And there are a lot of businesses that y'all are looking at that may be very tuned into or very focused on residential business. That's not a bad business, because if people have plumbing problems, they're going to fix them, or they'll be flooded. So they're going to fix them. Americans have a lot of cash right now. A lot of Americans do. And my sense is there's an awful lot of noise. And if I were in your position, I wouldn't stop doing what I'm doing. I would look for a good company. And I would keep the context of your question in mind. I think it's an important question, but I would also only let it change my mind if I had good tangible reasons to think that it will. And I tell you what I'll do, I will reach out to Alan and see what he can tell me. I've got some other friends that might be able to give me a little bit of context as to what's happening there as well. So I'll reach out maybe next week at this time. We can chat through that. But I would not just panic. The worst thing people can do, really, in my opinion, is panic. And if you're looking at a company and it's really dependent on a sector that is, it could well be. I've thought for years that commercial real estate was going to have some tremendous problems, and it's never come to pass, for 10 years. And there's a lot of reasons to think that it might, but it still hasn't come to pass. So, there's a lot of words. I'm not sure I gave you anything you didn't know to begin with, and I apologize for that.
No, yes, thank you so much.
I just don't know. I don't know the answer. I just don't like the idea of panicking based on all the noise in the environment, because there's an awful lot of it, has been for a while. What else?
Thank you.
Yeah, sure. What else? Anything else, guys? Well, Andy, do you have anything for us?
None so far. Thank you so much.
Okay. Well, if there are no further questions, I will give you back a few minutes. I think, what is it, 10 or 12 minutes? And I appreciate your questions, and I appreciate your attendance today.
Thanks, Dana.
Thanks.
Okay. Thank you all.
Thank you, Dana.
You bet.